Hello, everyone. We're going to go ahead and get started. Welcome to another SynMax webinar. I'm Sophia Lachapelle, an account manager here at SynMax, and I'm joined by Eric Anderson, our CTO, and David Bellman, our Vulcan product owner. This morning, we're going to go ahead and introduce Vulcan, SynMax's newest analytical tool, and we'll elaborate on the methodology that it uses for tracking coal pile inventories, as well as give you a taste at the sort of insights that it can offer to the coal, gas, and power markets. As we go through, feel free to submit questions into the chat function, or you can hold your questions for the end for our Q&A. Alternatively, you can reach out to us at info@synmax.com with any questions or inquiries that you might have. And with that, I'm going to go ahead and hand it off to Eric.
Awesome. Thank you, Sophia. Good morning, everybody. We really appreciate you taking time out of your busy Friday morning to join us for this webinar on our product, Vulcan. I'm going to do just a quick introduction about Vulcan, the strategy, the reasons why we think it is going to be an alpha generating data set. Then I'm going to pass it off to David Bellman here, who's going to go into more details and specific examples of how Vulcan can be used to find alpha generating opportunities in both the power, gas, and coal markets. So a lot of people have asked us, why we have this emphasis on coal, especially when it is no secret that coal is a declining generation resource, at least in the United States. And I think it's particularly because coal has entered this period where it is still a dominant, important, and relevant generation tool as a part of our power grid. But at the same time, it's in a lot of transition and there's a lot of uncertainty with it. And those types of moments, which we expect to persist and we expect the volatility to actually increase, kind of create opportunities for people to help balance the market with particular insights and information. And, to our knowledge, there really is no other tool that is doing this type of analysis. So, at SynMax, we're always looking for the opportunities where we can find alpha generating information, and technology that can generate that alpha. And Vulcan is one of those great examples. As David's going to talk about in a minute, we're using a technique called satellite photogrammetry, which is a relatively new technology, at least in the way that we're applying it. Traditionally, photogrammetry is used with just 2 photos, satellite taking a picture at 2 different angles. We're actually combining 5 different angles to develop a product which is creating unprecedented accuracy. And David's going to go through some of those accuracy statistics. And how this is relevant is that coal, unlike gas, is a far less fungible and much more rigid supply chain. There's particular grades of coal. There's particular routes that coal has to take. It's less capable of adjusting quickly, and this can create some sticking points, as coal generators can't always anticipate what their future demand is going to be. One of those components is that they have to hold on to a localized inventory for what they think their generation is going to be. And if they, in one of 2 situations, either underplan or overplan, they can end up with a problem of having too much coal and being forced to uneconomically generate, or having not enough coal and not being able to take advantage of what otherwise would be economic opportunities for them to generate. We've seen this happen in the past. We will see it again in the future. In fact, we think that as we're in this transition period, we're going to see it more in the future, particularly this summer, which is something David's going to talk about. And so we created Vulcan as a way for traders and market participants to be able to help better plan around these events and to help better trade market resources so that we can create stability. With that, I'm going to pass it off to David, who's going to dive into the details. David?
All right. So let's move on to the next slide here. So as Eric was alluding to, the basis of Vulcan really came from having a better understanding of gas generation demand, particularly when coal units may generate more than what economics would say. And those time periods occurred when gas was cheap, sub 250, and you saw that coal inventories can get quite high at plants, and you have actually a safety issue at that point, so the coal units will have to burn. Or, they do have other opportunities. There's 2 options for a coal plant when their inventories get high. One, they can push back to the producer and via legal action declare force majeure, go through the legalities of the issues of not taking coal, even though you were contracted to. Or, like I said, the alternative is just to run the plant and deal with it and therefore push power prices down and gas generation down. And so the latter is the common approach, particularly when you're a regulated utility. And so we see that in the past. So what we're trying to do here is develop something that can help you project the weekly gas storage and help you with the longer term gas fundamentals in regards to the gas generation side of things. So we have a couple goals that I just want to go over. We wanted to forecast coal inventories at specific plants to regional to total U.S. market, which I think we are doing, which will give you better precision relative to what you see in the marketplace. We also want to develop a dashboard that can catch you up on the coal and power markets. And it's designed for a lot of the non-power, non-coal experts. And so we believe that we have done that. Our forward-looking goals that we're working on and continually working on is we want to create a one-stop data source management for all your EIA-related data feeds, organized in analyst-ready formats, meaning that you can download them via API, Snowflake, and integrate efficiently with Tableau. We also want to offer insights to the power markets, which can ultimately impact gas burns. We want to look at new builds, retirements, and renewable performance. And we want to offer forecasts and insights into the future of the coal and gas market, power markets. So it's an interesting, when you're in the power markets, you have to connect so many dots because of the integration with gas, coal, renewables, nuclear generation, and it becomes a huge web of data, and you kind of have to organize it all. And so that's something that we're working on for you guys. So if we go back and just look at the basis of Vulcan, which is really looking at coal piles, we can see coal piles from space. And you can see on the right there, those are images of coal plants with their piles. We initially selected 100 coal plants, and we went through and we chose them based on their responsiveness to price. And you can find that by looking at the EIA 923 data and looking at when price changed and when it became low in low time periods that the plant changed their operations. And so that's how we selected our plants. And then we had to filter some more because some plants were very hard to view, and you couldn't get a consistent satellite viewing from certain plants. Ultimately, as Eric talked about, we use photogrammetry and stereo images to generate that 3D surface. And I think the next slide covers a picture of that. So there are multiple pairs of images taken from different angles, and you use a parallax effect created between corresponding points in each image to determine the elevation. And so you could see here the top picture actually shows like the end result of all the calculations of the multiple images to get the height. So initially, what we can definitely know and what we can definitely understand without even going through the whole box of calibrations and connecting it back to some EIA data set was to just observe at each individual plant what we are seeing. So that doesn't require much thought. It just says, okay, take these 5 images, calculate a volume, let me know where it stands relative to last week's calculation or last week's, or our whole data set. So what we can do is we can track these individual plants and see if they are observing high inventories. So our first chart that we have created and have really pushed out to our clients is an understanding of the trends in the marketplace. By observing these 73 plants, we can see if individual plants are getting high inventory. Because ultimately, a must-run situation doesn't occur just because you have high inventories. It occurs because particular plants have high inventories. And so that is a key thing or a key metric that's coming out of Vulcan. The other thing that we had to deal with, because now we wanted to be able to get regional tons and total tons, is how do we take what we are observing from these 73 plants and actually compute and tie it back to, let's say, a source. In this particular case, the source being EIA. EIA data for individual plants is around 2 to 3 years in arrears. So right now we have December 2022. That is the last individual plant data available from the EIA. Now, what they do offer is EIA 923, which shows consumption and received at individual plants. So in theory, one should say, okay, if I took those two and took it from December 2022 and use those two metrics, I should be able to compute a monthly inventory at individual plants. However, if that did work, then going backwards should work. And so what we did, we applied that theory going backwards by individual plants for every single plant in the country. And what you'll see here in what was presented here, what I just presented the total, but every individual plant, that methodology going backwards is different, meaning that there is a balancing item, which is a common metric used for the gas markets. You have this concept where you're missing something. And every individual plant has different balancing items going back. Some are relatively consistent, some are all over the place, and some are okay or zero most of the time. And so what basically the conclusion is, that methodology does not necessarily work. And the reason it doesn't work, it could be because you have wash off from the barge moving. You have a contract that says I will deliver X coal within X percent, and so the utility is just reporting what's in the contract, but not necessarily reporting the actual shift or volume. And the point is, the data is not necessarily accurate to just use consumption received. And if you are using that data, word of caution, you might want to test it back and look at it by plant and figure out which plants that it would apply and be applicable. So we did that. So with our 73, we made sure that what we were looking at for individual plants balanced off with the EIA 923 when we did our analysis to get from total and regional stocks. So we have a methodology where we basically say, okay, we know these plants. How well does these plants be able to forecast total inventory? And how you can do that is you can just take those plants and run a simple regression in the history and say, okay, I know these plants, how well does it move with the totals? And surprisingly enough, you'll produce an R-square of around 0.9. And now, how is that possible? It's possible because, once again, our criteria of how we selected the plants, these plants were most likely to price respond, which therefore most likely to represent the change of inventories. And so that's why we get a very strong R-square. So what we take from our plants is that we can forecast total inventories, and then we also did it by region. So we broke it up by region, says, okay, these plants represent this region. How well does it do the totals? And so when you see our total PGM, it's actually by state. When you see our total MISO or ERCOT, it's total Texas, it's total MISO regions by state. So what you're seeing here, I basically got rid of the histories just so we could focus on the red line, which is the Vulcan weekly snapshot of inventory. So you have two different cadence here. You have the EIA, which is a cadence of once a month, which is assumed to be the end of the month. And then you have a weekly cadence of Vulcan. So the odds of Vulcan and EIA actually being on the same day is essentially zero, meaning that within a week, I actually can't plan within a week that, like say Amos coal plant is going to be envisioned or satellite and converted on Friday. I can't guarantee that. Sometimes it's Thursday, sometimes it's Sunday, but we are focused on trying to get a week cadence of the satellite image. And at the same time, the EIA on the other end, I'm sure they're requesting the utility to file, their inventory levels and all the consumption received from the EI 923, but do they actually get it on the end of the month? Probably not. So you can see here that the weekly cadence, which is the red line, versus the blue line, which is the EIA 923 totals of the US, you can see that we have a leading indicator from Vulcan of where coal inventories go. Now, February just came out. It was less than a week ago. And you can see that February jumped, whereas we did not jump. Now, that's an interesting number. And I will address that at the end on the sensitivities of why we think that number is probably not correct. So coal demand and coal production has been extremely low, which has helped the situation. And if you look back and you look at how some utilities plan, they do run a simulation, let's say in October, and they run it through and they predict how much they're going to consume next year. And so they can do their contracting. Most coal is contracted, not purchased on a spot basis. And you can see last year in last October, you had a price movement upwards, and that translated forward, therefore their purchases were probably lower. So the price signal was allowing, and it had nothing to do, well, it had less to do with gas and more to do with the gas, with the coal costs coming up. Now, coal costs, we are observing, have started coming down. How we do our coal costs is we take the 12-month rolling average of what is presented in the EI 923 by region, by state, and apply it to create our regional coal prices. So that gives you this basically delayed response to the market, which is more accurate because it is an annually contracted environment here. So because of these coal prices were elevated, they probably procured less, and therefore production has been also less. So that's kind of worked out in their favor with gas prices being so low. The question is really, as we move forward, even though coal demand is down, there is still need for coal, and you have to replenish coal mines, but they are at higher elevated costs from labor to equipment and everything else. So will coal prices come all the way back down to historic levels? Probably not, but will it still come down? Yes. That would be my conclusion. And we're seeing the trend that it is coming off, as you can see in that chart. So, the coal industry has actually been quite resilient, given this death by 1,000 cuts. You can see here, this is all the regulatory nuances that have been pushed at coal on the first chart on the regulatory timeline. And then, of course, the latest attempt to kill coal is the carbon pollution standard just released by the EPA. Essentially, this is forcing coal plants to have carbon capture sequestration without really the technology being readily available and understood. So expect lawsuits. And I can conclude at least the last part of readily available and understood in the sense that there are a significant amount of permit 6 wells submitted to get approved by the EPA, over 128, I believe, and only 6 have been quasi-approved. So they have this long queue. So can the technology actually be used? Can it be implemented in a timely fashion? That is yet to be known. The other concept, and I think that a lot of ISOs are starting to see, is the undervalued appreciated attribute of coal, which is coal plants have an opportunity to hold vast amounts of container-less on-site storage. That's a very important nuance. So, obviously you can hold, oil as backup, but you can only hold so much, unlike a coal pile, which can hold quite a few MMBTUs, and it'll be on site. And so if there was an issue where, God forbid, pipelines had issues, obviously we saw some of that weatherization impacts in Uri. The coal plants are there to hold this inventory to get by on large amounts of BTUs if there is a unseen event. In fact, if you go back to the blackout that happened in the Northeast, it was I think a week, but if it wasn't for the coal plants, we probably couldn't have started up the grid that fast. Like I think if you actually did a calculation of how long it would take to start up the grid if it was just on nuclear, it would be quite a long time. And overall, because of all those rules implied on coal has actually been very clean outside CO2 issues, because the SO2 emissions is really below 1911 absolute levels. So it's not adjusting for GDP. This is just the actual facts that we put so many scrubbers on all the coal system that universities such as University of Iowa is recommending farmers to introduce sulfur into the soil, because sulfur is the fourth most important nutrient. But it used to be free because we had so much sulfur emissions, but now we hardly have any coming from these coal plants. So with the low gas prices and poor dark spread margins for most of the year, until recently, of course, I'm sure all the ERCOT traders are very disappointed. And I say that most of them are disappointed because they're either disappointed because they lost, or they're disappointed they didn't size up enough. The volatility and the dark margins have been poor until recently. So this is another reason why we were observing the gas ratio to be quite high on favoring gas generation over coal. I think a bit of that will be reversing, and we're seeing that. But if the gas ratio was closer to the average, basically that would have been 3 BCF a day of gas burns, almost 400 BCF. The other thing that's interesting to observe is that we all pull the EI 930, which is the hourly generation, and we all look at that, and we use that as our metric for understanding where generation is. It's important to know that the EIA 923 and also the EIA itself notes that the EIA 930 is not as accurate and as the EIA 923. This is in their own data notation. The data published in the hourly electric monitor may differ substantially from the data reported in other publications. These data include the net generation totals and net generation by field type collected from individual generators on Form EIA 923. So I started looking into this, and what's interesting is the EIA 923 would indicate a higher gas burn than the EIA 930. And I was trying to figure out where it was coming from. And a lot of the differences actually came from the state level increment adjustments, which are found at the bottom of the EIA 923. And that in itself is around a 2% impact so far this year, which is almost 1 BCF a day. So that's something to consider when you're trying to figure out your balances, and also trying to figure out what your actually objective is. Is your objective to match the EIA 923 storage or the EIA gas weekly storage, or is your objective just to really understand on a micro basis what's going on now? So you may need to have an adjustment for that. Obviously, we are seeing significant renewable builds and retirements of fossil generation, which will erode the generation capability of the fossil fuel fleet. So far, solar and wind generation incremental versus 2023 is 14 terawatt hours, which is around 7%. This amounts to under a BCF a day. What's interesting is the capacity build is actually 18%. So it's probably a combination of weather is not as favorable for renewables this year, but at the same time, maybe these incremental renewable developments are not as fruitful as previous renewable developments. And that would make sense, right? When it was less economic at the time, because costs were higher and efficiencies were lower, you would find the best situations for your solar and wind. And as the time goes on, those best locations are taken up. And so perhaps we are also entering a period where you are going to see less efficiency in regards to the conversion of solar and wind to power, because of the sites are dwindling in terms of prime spots. Load growth has been quite bullish, and there's obviously a lot of talk about that. This you can see here is the PJM's revisions of their load forecast. Total generation only has recently broken out relative to the past, and so mild weather has masked some of the load growth. I do want to address the AI data center load growth. Fantasy, yes. This is Goldman Sachs chart, and in the Goldman Sachs chart, they claim 600 terawatt hours of load growth from 2023 to 2030, which is essentially 68 gigawatts of capacity. All right, so I'm going to give you a frame of reference. So Grok 3, which was basically X's form of LLM, came out and they gave the data. They said they used 100,000 H100 GPUs. That, when you look at that, is 700 watt peak hours. Okay, so 700 watt peak for each H100. And then if you say, okay, what is the total facility usage? There's a chart on the right there that says, okay, 51% is IT systems. So I'm going to just basically double that 700 watt times 700,000 times 860, or whatever the metric is, and basically the total number becomes 137 megawatts for Grok 3. So if we believe the 600 terawatt hours, essentially by 2030, you're talking about 500 active Grok 3s in the projects by 2030. That's an amazing amount of build out. We had this little argument about how many LLM models would you use personally, and I do agree that you would need a model to maintain your home, give you directions, drive. So there are many use cases of it. But to build that much and have that many active LLM models that are continuously training, I don't think that's possible. And just the analogy, and probably a wrong analogy in the sense of the magnitude, is search engines. How many search engines do you use now? I remember when the internet came out, there was like 20 to 50 different options, and now there's essentially 2 or 3. So if the utility builds to this type of level, they could be in a surprise event. In fact, you're seeing that Duke is coming out with contracts that basically it's a take-or-pay contracts if they're going to build to your capacity, and that's probably a smart and wise thing to do. And last point is, training these LLMs is 90+% of the power consumptions. Inference is not much. I'll give you another analogy for this. If you were going to do, let's say, an animated movie, and you did all this processing and power, and you built this, Shrek 5 movie, you would eventually use all that power to generate and build it. But then when you're done, you're going to broadcast it to 8 billion people, and that amount of power to broadcast it is hardly anything relative to the amount of power that you use to build that movie. So, I think we have to be very careful of that lumpiness of training to the actual inference uses.
Yeah. Another point of consideration really quick is that every generation of NVIDIA GPU, which is what is used in these models, is more efficient than the last, right? So SynMax, we've got about 15 A100s running to process our models right now. Those are now, a little bit of a dated GPU. The H100s, I think, are 25, 30% more efficient per teraflop of electricity. And, we expect that we're in the early years of these efficiency gains. The technology is very nascent. I think that this isn't like air conditioning or cooling where, you're kind of plateaued in your ability to create it more and more efficient. I think there's still a lot of efficiencies can be created in all the next generation of GPUs.
Yeah, and I spend a lot of time in this field. You're also getting efficiencies on the software side. So those that are into this LLM world, you can look at Llama. Llama 3 came out. They even have the ability to run some of these things on phones. I mean, that's the amazing thing on the software side. The technology is also improving, and so you can get the same result, but with less GPU requirements. So one of the things that recently that we worked on is basically a gas burn scorecard. So we're working on generating this, and this should be displayed on our dashboard. So it'll give you a quick snapshot of what's going on and help you adjust/bias your gas burns for the week reporting and the week coming up, and also give you a macro understanding of where things are going. So we'll have obviously we'll have our Vulcan week count, our Vulcan total inventories, the dark spreads for both PJM and ERCOT, coal generation, gas generation, solar, wind, total. And I think I was going to add nuclear here too, so that nuclear doesn't really swing every week, but it's good during the shoulder months to be able to observe that. So what you can use this for is basically to make an adjustment to your gas burns. On an individual plant, I just want to go through a couple individual plants to let you know that we are actually monitoring at each individual plant. On the dashboard, there is a map where you can click on each plant. And when you do click on the plant, you'll get this summary here where you can actually see the picture of the coal pile, and you can see where they are in terms of where Vulcan is seeing it. So if you look at the green line, which is Vulcan 24, you can see here that we're showing particularly higher inventories than using the EIA 923 method, which is consumption received. And I would bet that this is more likely the reality when we do get the data 2 years from now. This is the Amos coal plant. Also, the same kind of story, except for it's a little closer than the EIA 923. There's just the light blue line there. And so you can see that it is also at the high end, and where basically we're saying that Amos has not really changed too much inventory from the end of the year. And here is one where we're very close to the EIA 923, which is Sherburne County coal plant. And you can see this one is in Minnesota, but it is also at the high end of inventories. So I wanted to give you some outlook, at least some thoughts of an outlook of where this could go. So if we look at coal stocks, it is really a multivariable problem, meaning that, okay, what are you going to deduce for the imports and the exports? What are you going to deduce for the production? What are you going to deduce for, demand? And so I basically created a scenario where, okay, well, I'm going to let the net imports be consistently where they have been. And I'm going to focus on two drivers, which is production and power generation outlook. So currently, the year-to-date average of production decline is around 18% relative to last year. And if we look at coal generation, it's down 3% relative to last year. So these are my two scenarios that I'm going to focus on here. So we're going to have a scenario where we're just going to leave it at 2023 generation levels, and then we're going to reduce that generation level by 3%. For the coal production side, we are going to have a forecast where we basically maintain 18% decline in production. But of recently, the production decline has shown 30% decline. So I wanted to create a 30% decline of production if we maintain that. Okay, so this creates a lot of different lines, and then also addresses our February update issue that I want to talk about. So let's start where we are now. So the 2024, which is the EI 923, you can see that's that green line that goes up, and it's showing record high inventories for the current month of February. If we look at the Vulcan line, which is more of this gray dashed line here, which is where we believe the inventories are, you can see that we're starting already at a lower level than EI 923, but we are actually, by the time, equaling their level in March, in April. So we have that forecast where we say, okay, if we're going to forecast 2023 coal demand, where are we going to be? And you can see here that all of a sudden, by week 25, 26, we are at this peak level of demand, of inventories, which we have crossed higher than what we were in COVID time period, divided by capability. Let me address this really quick because this is an important metric that we use. We do not use coal stocks divided by capacity, largely because there are several coal plants that retire particular units. And if you recall a picture of a coal plant, the inventory's capability to store inventory is not likely retiring. The unit may retire, but the pile space is still there. So we have adjusted for that by only showing up with coal plants that are available and that are in the system, and using the capability denominator instead of megawatts denominator. So going back here, so the red dash line is essentially using the 2023 demand of coal generation, and then also using the 18% reduction in coal production throughout time. So then if we do decline the generation 3.2%, you can see that it goes up a bit. So the decline of coal demand is not really a big swing, meaning that if I use the current year's decline year on year, I'm just really creating just a little bit of gap between using just the 2023 load demand for coal generation versus the 3.2%. However, if I do apply a 30% reduction in production, obviously it's a bigger number, but it has happened over the last couple of weeks, we can avoid the must-run situation. So it is really a question of whether that's going to happen. And then the other thing that I apply, just to let you understand, we can adjust Vulcan to the levels of the February release. And if we did that, it basically says that we are in an environment where must-runs could occur right now. However, you can see with our coal counts are still down, so I don't believe this to be a reality. In order to have this level of inventory this high, I think our 73 plants would have observed a lot higher amount of inventory counts. So that's why I think the February release is likely going to be revised or modified when we see the March release. But nonetheless, if production does not maintain its 30% decline, we are going to have likely a problem in the end of May to June, in terms of some units may be in that position to must run. So Vulcan, as we talked about, is just the beginning. We just started in the coal space to answer a question, but obviously once we stepped into the space, then we had to get into the power markets, and then we had to understand what else is driving things. And so now we are looking at what we can use Vulcan for in order to gain more intelligence, more understanding. One of the things that we're looking at right now is looking at monitoring via satellite all the new builds to see, if they are on schedule, where they are, and how we can apply that knowledge for our gas burns. We are looking at developing forecasting models. We are looking at retirement watch, and now we're also looking at temperature and load data sets. And we greatly appreciate your input in terms of understanding, our vision and getting feedback from you guys on where you want Vulcan to go to. And that's it. And are we doing Q&A?
Yeah, Sophia, should we open up Q&A?
Yeah, of course. So everyone can go ahead and submit some more questions into the chat if you want, but I have a couple to kick us off. One is the plan to start monitoring coal globally as well as within the States?
So that's not the plan, but I don't know. David, what do you think about that?
I think as long as there's a client demand.
Yeah. So
we have a process. The process is uniform.
There is no limitation, but of course there is a cost, right? And so, we have the capability to expand Vulcan, to any type of, it doesn't even have to be a coal pile, any type of pile, right, for measurements' sake. And we've had client discussions where people have also talked about interest in port monitoring or monitoring coal plants in other countries. All of this is possible. What we need is a clear signal that this is going to provide value to you, right? So we can have our own opinion on that. If you have an opinion on that, please share it with us.
Have you also looked at adding a component of transmission to your monitoring, like transmission build out relative to renewables or et cetera?
Transmission build out. So we've looked at renewable development monitoring. We have not looked at transmission monitoring. That transmission build out, I expect would be very similar to pipeline build out monitoring. It's definitely an achievable goal. David, do you have thoughts on that?
Yeah, we could definitely see a structure. It's much easier to see a transmission structure than probably a pipeline structure.
Yeah, and something interesting, there's a technology called SAR, synthetic aperture radar. It's been around a long time, but it's getting really, really better, and there's a lot more commercial constellations of it. I've read papers where people use SAR to measure the load on individual transmission lines because the shape of the lines changes as they take on more and more load. So not only could you monitor transmission, you could also monitor power flow through lines individually. So, this conversation comes down to two things. One, is it technically possible? And the answer is absolutely yes. Two, is it going to generate alpha in a way that customers will demand it? And that's where we need your input, right? We have our own opinion on these things, right? But our perspective is limited. We love conversations with customers and prospective customers because we try to be a dynamic and reactive company, that's delivering things as close to the customer as we possibly can get. So we'd love to have these conversations with anybody interested.
Another one we have here, how much did the NOx market have an impact on coal generation last summer versus lower gas prices?
It's a good question. I think the NOx market was an interesting play. Obviously, when gas is down, so there's basically a balancing that's happening with the NOx market, and actually in any environmental markets. So just because the difference in the variance from gas to coal is so large, is that they have to swing the price of the emissions to manage the balance. So if you give an allocation of X amount of tons, you have to apply a game theory analysis in order to find, I guess, funny enough, the Nash equilibrium, because we were just talking about this, in order to find the market equilibrium to balance the emissions. So, I mean, if you look at the numbers from last year, I'm sure it definitely played a part. But it was interesting that, in fact, we also talked about this. Vulcan can also be used in the other way, meaning if you did not procure enough, you could see low coal inventories and then a potential to not see burns, even though you think you should see burns because they're trying to manage the inventory levels. So perhaps at some level, our Vulcan attention will be on the low count, which we haven't even, we're not even thinking of low count, but certainly low count of inventory could be an issue. And obviously we have the capability to do that.
We had a comment on, can it get any more bearish for natural gas? So based on Vulcan and what we see there, what are your thoughts on that?
Yeah, so that was the point of this here. I think if we can move forward in this space, I think right there between week 23 and week 27, where you're above COVID inventory levels, that's where the gas generation, if I was doing the gas generation ratio calculation, I would be biased to a lower gas ratio for those weeks, only because those weeks have potential to be in that must-run situation. I'm not sure if coal producers and the the coal consumers really negotiated to allow a 30% reduction in production. It has happened for the last couple of weeks, but it could be a delay impact. Whereas, okay, I won't deliver it this week, but your obligation is piling up, and it is going to get delivered. So, can it be more bearish? I'm sorry for those bullish gas people. There certainly is a strong possibility in a couple of weeks where the gas ratio could be lower than predicted.
And then what do you see as some of the headwinds to dampen some of these extreme bulk power load forecasts?
Well, I mean, I think number one, renewables can perform much better. The potential for renewable generation to just, once again, it's a weather issue, whether it will blow and whether it will be sunny, could definitely reduce load.
Can this technology be used to track levels in floating ceiling / no ceiling oil tanks?
It's not the right fit for that analysis. Most people who are doing floating top storage are using shadow analysis. You only need one photo instead of taking a bunch. So that's a very mature product. There's a lot of companies doing that. That was one of the early endeavors of Earth observation companies, was to track floating top storage. And I'm not aware of anybody using photogrammetry for it, just because it's more expensive. I'm paying for 5 photos instead of 1 every acquisition, and 1 photo, thanks to very precise information about the capture angle and the time of day. So you can just use the shadow to perform that analysis. Some people are even using SAR for it, which is a little bit more expensive, but there are some cheaper options out there. They just measure the difference. SAR is a very precise radar technology, so they can just measure the difference between the top of the tank and the rim of the tank. So I guess the short answer is no. I don't think this is the right fit for that.
All right. Looks like those are all of our questions submitted right now. So thanks everyone for joining us. Like I said, you can submit any more questions or inquiries at info@synmax.com. We'll be sure to get back to you, set up a call, whatever it might be.
Closing comment from me. I just want to say thank you for making it all the way through our webinar. We do believe that this summer in particular is going to be very critical for monitoring this story of a potential oversupply in the coal markets. And like David had talked about, this is not something that you can necessarily anticipate just by looking at the total number. It's going to depend on the individual plant level. And that's why Vulcan is delivering this data at the individual plant level, so you can know exactly when those uneconomical burns are likely to occur and where. For anybody interested in trialing this data set, please send us an email at info@synmax.com. Thank you very much.
Take care, everyone.
Have a good week.